What's up, YouTube? It's Joe Catchpolia sitting on the couch making some money investing in fractional real estate online, as usual. I just have this up. One of the things you might not know if you're ever trying to find my YouTube channel and you don't want to search, you can always just go to apexcreditor.com and it redirects you to my channel. It's a domain that I have because of my lending business that I have in real life, and I just don't have it attached to a website, so I have it on here. I mentioned before that. Most of my net worth is tied up in properties where I bought the property all cash, sold it with a loan, and sold it, and I'm collecting payments over time. So when I was thinking about expanding that business further, this was the name I had come up for the business, and I had Grok making some different logos. This is one that I thought was extra funny, so I thought I'd share that today. But what I want to share with you today, I know I've talked a lot about investing in loans on ground floor. That remains one of probably my favorite place to invest in debt online. You can watch some of my videos to understand why that is. Again, just because it's my favorite, it doesn't mean it's the right answer for you. But it is definitely one that if you are interested in investing in mortgages, I'd take a look at. I have a link in the description below for ground floor, just like I do for Lofty and Mogul. Mogul doesn't have any debt component right now. Just to recap, I had talked about Arrive's private credit fund, but I didn't think the yields on there made a lot of sense relative to the risk profile. And I felt the same way about Landa's lend program. That one, I finally did get my money back from Landa. It is, I don't know, I would not put any money in their lend program, but again, that's my personal decision. You are welcome to make a different one after your own due diligence. But one of the things I want to give you a little warning about this one, the Universal Lending DAO on Lofty. When you look at it in the marketplace, it shows this really high cap rate. And I keep clicking on that, but it shows a very high cap rate, which is not really a cap rate. It's not what it is. Lofty's marketplace is not meant to handle this sort of an entity, and so this entity is what all of the other entities can borrow from if they don't have the capital for a repair or to pay their property taxes or something. For temporary reasons, right? Like if as long as they're still appear to be solvent, they can borrow from this. If you own tokens in this entity, you get to vote on every loan that's made. Right, you can look at all the loans that are outstanding on here. There was a couple of things when I brought this up before, and you can see, every other property that has an outstanding loan, how much they paid, how much accrued interest. But a couple of things that I wanted to mention. So, one, why does this yield match up with the stated interest rate? So if you look in here, it says it says your estimated APR is 13.5. The terms of the loan, they're all at 13.5%. So why would right now the yield be higher? Well, when I first bought them, some of these tokens, my yield was only 6.5%. And then it has since more than doubled, and it's almost tripled, and now it's 18%, or over that. The reason that I think that's happening, and it took me a little while to figure this out, is the interest accrues at 13.5%. But the way that the payments are set up, properties only make payments when they have cash flow, and so and they only make they only pay 50% of their cash flow, or 50%. 50% of their net cash flow if they don't have a half full operating reserve, and you can read all this on here. And so that means, a property that's fully vacant, it might start accruing interest but not be paying any. And so you're just getting paid out each month based on whatever's actually received as far as interest payments, at least as far as I understand. I have asked this question of Lofty and haven't gotten an answer yet. But when I've done the math in my own, the ones that I'm getting myself, and when I look at the spreadsheet and see the payments that are made, it seems to me that that's what's going on. And so some months they might be accruing interest, but it's not being paid because the properties don't have the cash flow to pay it back. And so I would expect that over the very long run, your yield should look very much like this 13.5%. I actually think it'll end up being a little bit lower than that, because the reason it'll be a little bit lower is, it won't be all the funds won't be 100% invested at any given time. And there are a couple of things that are unclear to me as well that I'm still trying to figure out when you buy it. I think I mentioned this in the other video as well, and I still don't have a clear answer. Oh, I don't have any funds in there, so let me just put it as if I'm doing it with a credit card and preview this order. So I just want to show you um, what's going on here. Did I click that? Do not submit that. Nope. Okay. When I look at the fees, there's an operating reserve contribution. When I asked, well, what happens with that, they said, well, we just lend that out too. And so obviously that kills your yield to have to pay that percent on top of your token price. Although right now they are selling tokens, and these are coming from Lofty for $49 each. So you're getting a little bit of a discount. It's not quite enough to make up for the fact that you're, paying fees and sticking an operating reserve in there. But once you overcome those, in the very long run, your return should look a lot more like this 13.5, not this 18.6. Also, not the lower rate that I had before, which is 6 something. So I just wanted to make sure that was clear, because I think they really don't do a good job of, there's not a finance tab, right? All you get to look at is all the outstanding loans. And so I had to really spend some time and look at the interest accruals and the payments. And my math still didn't come out to be exactly what I would expect it to be, but it's close enough that I think that I understand that, what I'm explaining is actually what's going on. Um, one of the things I like about this is you're purchasing one entity, but you're getting a bunch of outstanding loans, and some of them are really small, right? Some of them are just like loans that were taken out to make some sort of small, insurance payment or something for an entity that just didn't have the cash in its account at the time it was due. Um, those are, in my mind, relatively safe bets. The one of the things to look at is that, what happens if they don't pay? Well, if there's still money owed at the end of a 4-year repayment period, the DAO is allowed to push for a sale of the property, or if let's see, they have the ability to liquidate. If for if they don't get paid back the debt within the 4-year period, right? And so, um, if that entity is just sitting there moving along, but it never gets enough cash flow to where, the 50% or the full amount is actually making that payment, that your interest keeps accruing. And then at the end of that time period, the lending DAO can say, okay, you know what? We're going to force you to liquidate the property. You've got to sell that property in real life. Um, as far as I understand, it's actually just done like Lofty makes them do it. And so, uh, I tried to get loan docs for this and asked a lot of questions, and they didn't make it very clear. And I think what they're doing is they're just planning to enforce this themselves. I don't think there's some document. Well, I guess there was some document signed between the entities that they shared with me, but it seems like, they really are just banking on the fact that they just control all of these entities, to a certain extent. And so are going to be able to do that. You're not getting a lien on the property itself. So if, just for example, some other creditor forced the other entity, foreclosed on it or forced it into bankruptcy, you could certainly lose your, lose the money that you lent to that particular entity. But again, you're getting pretty wide diversification, because there's a bunch of different loans that are made in this, right? I mean, there are a couple of large ones, some of these larger ones, these make up the bulk of what's being lent out. But then you have, a large number of small ones as well. So, you have a little bit more diversification as far as the loans go. You don't have like I said, you don't have an actual lien on the property, but you have this mechanism to where, Lofty can initiate the sale in the other entities. Um, Overall, I like the concept. I think, yeah, I own 30 tokens at the moment. It's something that whenever there are cheaper tokens that come up, I'll probably buy more. At $49, I don't find them super compelling. One of the things that I've actually done on another property, and and I don't know, it hasn't gone through yet, but it seems like, uh, based on the way things go on here, that I think that it will, is you can also lend to entities that you own when they need capital. So, for example, I own some of this property. It's vacant. It needs capital because we're switching property managers. We need to pay off the old property manager the debt that we owe them. At the moment, that Universal Lending DAO doesn't have enough cash to actually make a loan to to this entity. But we needed some money. So what I did on here, and what we're allowed to do, is propose a vote where, the entity just borrows from us as owners. It's very similar terms, although you can propose whatever terms you want. And because we're kind of stuck at this moment, and I'd like to be refinanced out later, I proposed a higher interest rate on this. We'll see. That vote is supposed to finish on Monday, and we'll see what happens with that. But if that goes through, I really like the idea of, um, real estate debt versus the equity portion for me at the point in my, investing career that I'm in, right? Like, all of these discounted tokens that I'm looking at for other properties, I think I'm going to get some nice returns on those. I think, I'm spending time and going to get a little bit of extra money, but more and more, and that's sort of the way I approached real estate before, a little bit more active, trying to do things from creating value. But more and more, I'm just concerned with not losing the money that I already have, and, getting a good yield on it, but a good risk adjusted return. And so that's really, made me lean towards debt in a lot of different types of investing. Like I said, in whole mortgages in real life, it's one of the reasons why I really like ground floor, and I'll be putting more money on there. And I think over time, I'm going to try to figure out more ways where I can lend on here, right? We can already do to the individual entities that we have when the need arises. We can do it through the universal lending DAO. Um, I don't see any reason, especially if I have properties that I feel really confident in, and that like this one, it seems like we have a really big chunk of equity relative to the total price. And so I don't mind doing a capital call and lending a significant, portion of cash to this, if I'm going to get 15% or something higher. And, when the other entity is back up and has cash to lend again, maybe we just always have to go back down to the 13 and a half, or else why would they do it? Um, but I guess we are also allowed to, adjust the repayment terms. So I don't know. Maybe there's other ways to structure it to make it more attractive than using the universal lending DAO, but also give us a higher yield. And so I think that um, that's one of the things that I'm always exploring, is different ways. Like, on Lofty, you can get really creative. There's, some of the owners that have brought properties onto the site are doing all kinds of interesting things, as far as structures. Um, and Lofty does a good job of assisting with it. And I think, and they're also talking about a program where they're going to lend you money to buy tokens. And that's sort of the other side of things, right? Like, I don't think I'm going to do that. Um, but I think that is, I'm going to start to look at that a little bit further. One of the other things that I wanted to mention is, when I talked about staking before, I think that really they call it lending, right? This is their lend and earn tab. And you are, like, either lending USDC or tokens into the pool. Um, and you can see I've done this quite a bit now. These returns are simple returns calculated, like an ROI. So it's like it's not annualized at all. And so some of these have only been here in a short period of time. So if you see these and they look terrible, they're really not that bad. I think my actual return on all this is somewhere around 8%, but I'm lending these tokens in the pool that I already own. And so I'm getting, some portion of return from the ownership of those tokens and then some additional return for lending the tokens to the pool. But the more I really understand how this works, this isn't the same as, like, especially when you put USDC in here, which is just, the money. It's not the same as making a loan and getting, you're not guaranteed any sort of interest. Oh, excuse me. So, that's not, you're not getting that benefit. And so what I think this is more like is kind of like buying the VIX for, any one of these properties. If you're not familiar with that, like the volatility index, like when you buy in the stock market, you're just basically, you make money when there's a lot of trading, but you're not, so all the fees that you get on this has to do with when those tokens are bought and sold. So like on ones that I own stuff, have some money in both sides, I'll make money whether those tokens are bought or sold. If just have tokens in it, it's only when people buy out of the pool. It's not when they sell back into it. Um, but there's, I've discovered there's ways to like sort of figure out which ones you're going to do a little bit better and worse. But this is definitely not lending in the sense in the way that is attractive lending to me. I am doing it with lots of tokens because it is like a nice little bonus. But you can see I only have actual cash left in a couple of these, and it's only because there's big penalties to take my money out of these three. I took my cash out of all the ones that it let me, and that it let me take it out without penalty, because I don't see this as being, especially when you're lending on um, I think they call these the quote token side versus the base side. Um, it's certainly not like the same as, if you're looking for a debt instrument, this is just not it. Even though it is, what they call. I want to show you where they say that too, just so you see. Let me just move this little guy over there. Yeah, this is lend and earn, right? And so that's where I got that idea that this is lending, and they do, so, total value lent. Like it makes it seem like this is a loan, and in a certain sense, it is like you're lending your tokens to the pool, but you're not making a loan with an interest rate and a repayment schedule or anything like that. So because of that, I think that if that's what you're looking for, this staking is not it. And I just wanted to point that out because this is something that I think when I've talked about lending on the platform before, this was one that I mentioned, and I really just don't see this as being the same sort of animal as the Universal Lending DAO or investing on ground floor, or even like Arrived's private credit fund or Landa's lend platform. I mean, all of those are to some degree or another more what you would typically think of when you think of debt or lending, and this is just not it. This is your I think it's still a useful tool, and it's something that you might be able to make money doing. But I think that to put it in your brain as if I'm lending money to this in the same way, it just doesn't work out. You're not able to calculate your return over the long run in any there's no reasonable way to make a forward looking projection of your return. And like, I mean, that's one of the most important things with debt, right? Like your return is your interest rate, and so you know about it up front. So yeah, I think I was really just mistaken to try to frame this as lending, even though I was just basically parroting what I had read and understood at that point so far. So I just wanted to make that correction. Um, and yeah, I think that's it. I think I just really wanted to make sure a lot of the different stuff was clear as far as um, the biggest thing. The thing that prompted this video today And I cannot get that one to come up. I've got a million tabs open now because I had accidentally a lot. But the biggest warning that I want to give you is just that this yield is just not the yield, or this cap rate and yield is not what you're getting on that universal lending DAO. There's just, yes, it is what I'm getting paid out this month, but it's only because in prior months interest accrued that wasn't paid out. And so this, that makes this like a much less stable debt instrument as well, right? Like I have no idea what I'm going to get paid each month. It's going to be based on the performance of those properties. Now, I think as it grows and makes more loans, it will smooth that a little bit, because it'll, on average, you just won't have the months where you're just getting nothing and then other months where you're getting a lot. But it's certainly, um, it's not like flipping coupon, getting your monthly. I don't know if you have to be sort of an old guy bond investor to use that clipping coupon discussion. But that's what they call it when you're just getting your payment every month and it's the same payment, and you're making that money. Um, so it's certainly not that either. But it's more like investing in a debt fund, although it's not. I don't think you could technically call this a fund. I don't know. I like it, but it is, it is just a little bit different from what I initially thought also. So I guess, at the end of the day, where most of my money that's going towards real estate debt is right now, other than making loans out in the real world, if that's something that I'm going to do, I think primarily I'm going to keep sticking that money on ground floor, and I'm going to use Lofty for a little bit more opportunistic, equity side plays, which is what I'm mostly doing. Although, like I said, I will look for opportunities to, structure debt to some of the entities that I'm an owner in, if I think I can get a good return and it's a very safe one. And if I'm already invested in a certain property, it's because I feel, that I've done some due diligence on it, and I feel like there's a good chance of making money, and so, getting repaid, I think shouldn't be a problem. I think that's really all I'm going to share with you today. Please do like and subscribe. I never remember to ask you that. It is, it makes it so other people see this, but it also just makes me feel good to be like, oh, somebody like this. Uh, yeah, I think that's it for today. Until next time, I'm going to keep making mistakes so that you don't have to.